have equity in that deal. So whenever that property sells, you will get that original investment back.
Hey guys, how you doing? Welcome to Millionaire Mafia. I got my buddy and creator of Bulletproof Wealth Strategy, Tom Laune, with me here. He's got a plethora of different designations and certifications, everything on the insurance side. He's also been one of the founding members of the IBC, Infinite Banking Concept Advisors, and all this other kind of stuff that I don't even know what they stand for, kind of like in aviation terms that nobody knows what the acronyms stand for. But he's got a lot wealth of information, and he's got this really cool strategy that I have used personally in my own life. And so today I'm going to actually have him get into my personal policy that I started about two and a half years now. But before we get into that, I want to have Tom kind of talk about every policy is definitely tailor-made to the individual person. However, there's kind of some general methods that he uses based off of the individual's kind of life situation and what they can and can't do. So, Tom, welcome to the channel. Appreciate you having you here.
Thanks, Jay.
And what do you got? What do you got for us today?
So today I wanted to break down the 3 different ways that I typically design policies to allow people the creative flexibility of doing what that works best for them in terms of how you can get money into these policies. So I have 3 different options, and they are the microwave, the crock pot, and the hybrid. Each one of these 3 things has a required portion that you have to put in every year in order for it to be considered life insurance by the IRS. And then the way that you put in the extra money is what is different. So for the microwave design, we're just putting in a large lump sum deposit, and that lump sum deposit is maximizing the amount that you can put in without this thing turning into a modified endowment contract. So that is just for somebody who has just had a large liquidity event and wants to dump in as much money as they can now, but wants to put in just the minimum each year to keep this thing going. The next one I have is where I call it a crock pot, because it's where you're putting in the same amount of money over time each year, and you have a required minimum, which is the base and the FPR rider, which I'll explain to you in a minute when we look at Jake's policy. But you have an additional deposit of paid up insurance that you're putting in that is even every year. So you're fixed the first year, and then year 2, there's a cap and a floor, meaning there's a maximum you can put in and then the minimum amount that is required. And the cool thing is, from year 3 on, there's a catch-up provision where you look back to the prior year, so year 2, and any shortfall that was made, you can catch it up from year 3. So it looks back to the prior year for any shortfall in your paid up additions that you're building inside of your policy, which, getting back to it, that is adding quite a bit of equity to your policy. So the third design that I do is the hybrid policy design, which is what Jake did. And this is really combining the best of both worlds, where you have a required minimum, you're doing a lump sum deposit, but not quite as much as the microwave, and then you still have an optional amount in year 2 on with the cap, floor, and catch-up provision. So that is essentially the 3 main structures. Now, I want you guys to realize that obviously every person is unique, and everybody has unique stories and unique ways that they want to contribute money. And Jake was no exception to that. And he has a very cool policy design that we did that is actually unlike almost any other one that I've done. He had a separation pay coming from the military. I believe it was in year 3 of his policy. So we designed extra paid up additions capacity to go in year 3. So I would call this a modified hybrid policy. And I'm going to share my screen with you guys and take a look at his numbers and show you exactly what I'm talking about. So for Jake's policy, this is the required minimum. So you just take the 10,000 682 plus 6547 of this term blend rider, and that is 17,229 is what is required. And the first year, Jake put in an extra 25,271 of paid up insurance for a total premium of 42,500.
What are those first two numbers of the pay of that 42.5, and what is that 25.2? So what goes to what there? What does that mean?
Yeah. So the base premium is the required minimum for whole life. And the FPR is a little bit complicated, but I'm going to explain it to you like this. It is a term blend rider that's not term insurance like you think of it normally as an external term policy. It's literally blended into this policy to add term coverage to allow us to put in these paid up additions. So what that term blend rider does is it increases your overall face value or death benefit to get it high enough to add the paid up additions. And in this case, it's blending in for 6,547. It's blending in an additional approximately 1.3 million extra of insurance. Now that term blend rider eventually gets paid off completely and it goes away. And that's what this number 3 is indicating, is the term blend going away. So what happens in these policies is that you have a required minimum, which is the base contract and the term blend rider. Then the APPUA rider is paid up additions. That is where the big cash infusion happens. And that pretty much goes to your actual cash value or the equity in your policy that banks let you collateralize against. So Jake put in 42,500 here, and he had 27,657 available as his cash value. And that is accessible after 30 days. So there's just a 30-day seasoning period once you start one of these to be able to take a collateralized loan. Now, I know that this is kind of going into the weeds a little bit, but I'm going to explain to you that the loan to value on your collateral capacity is 90% the first year, and then 95% traditionally every year after that. The way it works is that whatever the loan interest rate is minus 100 is what you can access starting year 2, and starting year 1, it is approximately 90% of your cash value. So Jake put in 42,500, and if you take 27,657 times 0.9, that's about 24,891. So rounding, we'll call it 25K that was available to borrow against after 30 days. And what was so unique about this with Jake's policy is that he wanted to design into it the ability to put in an additional $40,000 in the third year without turning the policy into a modified endowment contract.
What is a MAC? Just so we get that out, so people.
All right.
You've said it twice now, and we know what it is, but what is it?
Yeah, sorry, Jake. So a modified endowment contract is where the Internal Revenue Service, the IRS, looks at this and says, hey, this isn't a life insurance policy, this is an investment. Okay. And so they take away the tax advantages of it and they call it a modified endowment contract. And there's several tests that they run these policies through to see if they violate these tests. And one of them is called the 7-pay test. So prior to 1986, Jake, you could take $700,000 and dump it into a life insurance policy and you were good to go. But it all of a sudden started looking way too much like an investment to the IRS. So they said, hey, we're going to change this to where if you wanted to get that much money in, you'd have to make at least 7 equal payments of $100,000 each to get in $700,000 of life insurance. So that's the way that I explain the 7-pay test simply, but it's actually, all kinds of complicated math algorithms that go on behind the scene to make sure that what we're doing is we're putting in the maximum amount of money for the least amount of life insurance, so that we don't violate that MEC testing rule. And in this case, $42,500 was the most we could put in year one for a $2,626,000 face value contract. So, and what was really cool about this one is that we've got $52,771 allowed to go in the third year. Now, it was a fairly complex case because in order for this to work, Jake was going to have to make sure he was still in reasonable health, which he was. So we were able to get this money in. And that was designed from the beginning to have that capacity in his policy. So once he made this $70,000 premium payment, of course, it jacked up his cash value to, $115,000. So just in a quick breakdown, and then Jake, I want you to go over anything that seems confusing about this. Every year you have a minimum, which is those two numbers, and a maximum, which is this number. And then this is totally flexible. So if you want to put in $10,000 in year 4, then you could put in how much in year 5? It would be $32,771, because you could go back and make up that $2,771 shortfall from the prior year. So that's where I went into that look back provision of anything that you don't put in year 4, you can put it in year 5, catch up, and anything from year 5, it just rolls forward starting year 3. So that is what is really cool about the flexibility of the way that I do these policies.
And this is why you need somebody like Tom to actually do this right, and why there is a big difference between just going to like Dave Ramsey always talk about, a stock company or even a mutual company, and just getting whole life insurance, right? And just saying, yeah, I'm just going to pay this much a month and it's all going to work out. It doesn't work that way. There's a lot of stuff to make sure that you can maximize the amount that you can pay into paid up additions, which is really what we want to jack up. That's what we want to get the most out of, because everything else is the premium. There's some things that you get return of premium and dividends and stuff. There are some other benefits, but people don't realize. People look at the death benefit and they say, oh, it's for $2.5 million I could spend $100 a month and get exactly what you're paying $16,000 a year for. But the thing is it's not that it's not important, but we don't care about the death benefit. That's not the point of this thing. It's beneficial, but it's not the point of this bulletproof wealth strategy and the whole life policies in general. That's what people need to understand. They're kind of different. They're different things, right? It's just an extra benefit of that really awesome savings plan that we can actually use to leverage into real estate business, whatever we want, or fun things that we need. If we need to get a car, like we got the ability to take a loan from our cash value. One of the things that we'll get to a little bit is kind of the payback requirements on these, or lack thereof, which is pretty cool. Yeah. But what I want to talk about on kind of my policy or some things on there, or I want to talk about a couple questions since we're on my policy or the specifics of the policy. And you've already covered a few of them, which is the big questions I get is from people that are interested but aren't fully convinced or not sure. They say, what's the most I can put in and what's the minimum that I need to put in? You just kind of covered that. And I actually kind of forgot about the catch-up provision, which is pretty cool. So if you are a little bit light one year, you can put into it the next year, right? I mean, we're constantly ebbing and flowing in our businesses. Some years are better than others. Sometimes we have an opportunity where, it'd be great to put it into your policy, but maybe I can make a lot more money doing it this way. It just makes more business sense. And that's a decision that you and we have to make. The other thing that you covered, which I get a lot, and we'll just reiterate it, is how long am I till I'm vested? And you said 30 days. So that's really essentially really quick, right?
Very quick. Yes.
Yeah.
In the old school way of doing policies, you weren't vested in your terminology, or you didn't have any cash that you could borrow against until at least year 3. So it's just totally different the way that I'm structuring this. For maximum cash accumulation, but also making sure as a part of the Bulletproof Wealth strategy that your family is covered if something happened to you. I know it doesn't seem like a big deal, but I'm telling you right now, these things become a really big deal if anybody's health changes or if something were to happen. It's like a huge deal, the fact that Jake is killing multiple birds with one stone. He is using this for his business, but he's also protecting his family and children as well. So it's a really great double use for this.
Exactly. And so if you guys haven't read his book, What Would the Rockefellers Do? Garrett Gunderson has a really, something I kind of knew but didn't really think of. He has a really good explanation about people who say they're self-insured versus actually insured, right? And this is what that kind of comes down to, is that if you don't have life insurance, you have to essentially be self-insured for up to the amount that you would be insured for, right? So that actual insurance comes at a much lower annual, monthly, whatever premium than to be self-insured. Because if you're self-insured, you have to have that amount at all times. And if you don't have that amount liquid, it's really not making any money. So it allows me to have that amount forever down in the future, or, down the road, whenever, if I die this week or if I die when I'm 90, it's there, and I can get it at a much lower rate while still having the advantage of collateralizing that, and then also having what very few policies have, and definitely term doesn't, at least not to my knowledge, or not to the same level, is any type of liability or disability type insurance, where if I get hurt or injured or anything like that. And I don't know if you guys noticed that, but you might, Tom, can you bring up the screen really quick? I'm looking at the net death benefit on the right. So you see how it's pretty much the same all the way until we get a little bit later on. So would you mind explaining that change really quick? Because I think that's kind of a cool thing there.
Yeah. So what happens, guys, is that in the early years of this policy, the life insurance amount stays relatively the same. And that's because that term blend rider is being internally paid off inside the policy. But the minute that term blend rider gets paid off, which you can see it's indicated by this number 3 here, it starts going up in face value dramatically each year. So you can see this policy for Jake is designed to put money in for 32 years until he's 67. And it has a death benefit that has grown, or face value that has grown to $4,913,000 by the time he hits retirement. So it is absolutely phenomenal the way that as inflation happens and as you get a higher need for life insurance as you grow older, this thing accommodates that by increasing in its face value as well as the cash value. So let me just go over a couple of key numbers. This is super important right here, this $5,329. You might go, what the heck is that number? Why is that important? What that means is that in year 4, when Jake deposits $30,000, he could turn around and have access to $5,329 more than he put in. So that is the year when he puts in money and he has access to more than he puts in. So you can see he has access to $35,329, and at 95%, that is definitely more than $30,000. And as this thing continues onward, eventually we get to what I call full capitalization of your policy, which means that all of the money that he's put in from the very beginning is now available in his net cash value. And as you can see, that is happening for him right just past year 6. He's put in $232,500 and he has $228,675. And in year 7, he's put in $262,500 and he's estimated to have $271,000. So he's ahead in year 7, which is a really great thing. And then every year after that, the compound interest curve takes over and his cash value, cumulative premium outlay versus his net cash value, continues to just skyrocket. And as he lives and goes on, say, for example, by the time he's 60, he's hit a double. In other words, he's put in $802,500, but his estimated cash value, it's not guaranteed because it's based on the dividends that pay out in the future, and those are not guaranteed. But this is the best estimate based on the current dividend rate, is that it's going to be more than double all of the amount of money he put in. So he's able to use this in his business, and now he's got twice in there as to anything he's ever deposited. And the good news does not end there, because the thing that I love about this is that we've structured Jake's policy, and I do all of my policies for a tax-free retirement income. So the maximum amount of money that this policy will hold is $1,012,500 over Jake's entire lifetime. And in order for him to get the most out of this, we've shown that he can pull approximately, it's not guaranteed, but this is the best numbers I can run right now, $183,853 per year tax-free all the way until he's 91 years old, at which point he has distributed out all the $1 million that he ever put in, the $1,012,500, and he has an additional loan of $5,206,453 that he is going to never, ever, ever pay back, because when he passes someday, that loan will be paid off by the insurance company. And oh, by the way, his spouse and family is still going to get close to $1 million. So it's absolutely crazy the numbers that happen inside of these policies when given a long enough time to accumulate wealth.
Yeah, and that's the big thing there is that you can take essentially a tax-free income. It's very similar to kind of how you do it with like a Roth IRA or something like that, except for you get to control that money. And I know you can do it, during your work, your, self-directed or whatever IRAs, but you can't touch that money. That's not your money. That's your IRA's money until you take it out. And once you take it out, it stops earning and it has no other benefit other than the amount that you distribute. But during from the day, 30 days after I put money in till the day that I die, I can use that money however I want. I can go buy a new car if I want. I can do stupid stuff and buy depreciating assets, or I can go buy appreciating assets, or fund vacations and things like that, whatever I need to. And I think there's definitely wise ways to do it and not wise ways to do it, but I can use it for whatever I want. There's no taxable event, no penalty, anything like that the entire time of the policy. So, and as you saw, there's essentially no way to take more in the distribution and policy loans to not still have a death benefit to your family. So there's no way. And you see the worst it can get. It started going up again the next year. The worst is just a shade under $1 million that my family will ever get. If I completely tap this thing out, they'll get $1 million. So yeah, $1 million might not be worth as much down the road, but it doesn't matter. I've got $5 million something invested into something else up to that point, right? Because I'm going to take that money and use it to fund more deals that are bringing in ideally a lot more cash flow and things that investors like us do. And that's the point. The death benefit, and you can see that's why we keep kind of talking about it. The death benefit is a nice to have, but it's not really the point of these policies. It's just an added benefit of it. So that way, if I die next year, it's a huge benefit on the death benefit side. But if I don't die until I'm of old age, it's really inconsequential, because I've done so much with the policy through those years that it exponentially beats what just that small rate of return would have been over the years if it just had stayed in the policy. So it just always gets, the worst case is better than many other cases, I guess is a good way to put it.
Totally.
It's pretty awesome. So.
I just want to tell everybody that these numbers that we're looking at for Jake is based on his age and his health and his gender and a number of other variables. So all of these things will look different depending on how old you are, how healthy you are, what a lot of different variables of your income and everything. So guys, don't get attached to those numbers that we just showed you. They were custom done for Jake, and I can design a plan for anybody based on your numbers. Now, I will tell you this, that, obviously the ideal candidate for this strategy is you have to have some liquidity saved up somewhere to be able to move into a policy like this. There are ways to get started where you're just simply protecting your bankability or buying a convertible term insurance policy until you get your cash liquidity built up, and then we can convert it in the future with your health locked in. So that's something we can do. But in general, I'm looking for people that have some liquidity now to dump into this so that we can start the policy and have it make sense for you with enough money that it makes sense for you to move the needle in your business. Does that make sense?
Yeah, and the great thing about Tom is he's going to tell you straight up whether this makes sense or not. He'll literally tell. I mean, he's told people this doesn't work. This isn't right for you. It doesn't work
Yeah.
because you would pay. We've got people who aren't as healthy, and they would pay way more in premiums that would make sense to the policy. Or you don't have enough. There's no anticipated extra amount to put into this policy in the near foreseeable future. Now, like you said, you can do those convertible term, essentially like how we would use an option on a property where we can get in at a low price and kind of lock that rate in and be good forever. And then we can execute it. But if there's no plan or ability to execute it, then it doesn't make sense either, right? So he's going to he'll help you out with that. So, and that's the advantage, and that's the importance of having an actual person with all the qualifications, certifications, and somebody who's taking a holistic approach at your specific, not only policy, but your life and your investment strategies, right? Nobody invests like I do. Not that I'm special, but nobody invests like me. Nobody invests like my partner, Tyler, Blake, Bob and Jeremy, or Bill Allen. I mean, nobody does that, right? Because they're the only ones. So it's going to be tailored to you. So we're getting a little bit long in the tooth on this one. I know it's a little bit longer video, but there's a lot of important information on there. I know there's a lot of numbers. So if you guys have any questions, feel free to reach out to me, comment below, but the best person to talk to is going to be Tom, and because he's got all the specific and the corporate knowledge on this. Tom, if somebody needs to get a hold of you, what's the best way to do that?
So I have a website, bulletproofwealth.info. I want you guys to go there and put your name and email address to get access to a very deep and broad range of free educational videos. And once you've watched those, if you want to contact me, there's a way to book a time to talk to me by just hitting the schedule a call with Tom button inside of that video page. And guys, I put those videos behind a firewall so that I'm not trying to share those videos with the world. You have to sign up, and I want to know where you came from and how we met, because I'm not looking to work with everybody on planet Earth. I'm looking to work with the right people that I can help the most. So go to bulletproofwealth.info and sign up, and hopefully we can make a plan work for you.
Awesome. All right. Well, thanks, Tom. I appreciate it. I'm gonna go ahead and link your information in the description of this thing. So we talked about today, kind of the general methods in which Tom structures policies for his clients. We've talked about a specific example in my policy. What we're going to talk about in the next video is how you don't just have to take insurance policies on yourself. There's other people that you can take those out on, and there's really cool ways to be able to leverage them in your own business. So I did it with my policy with my wife and my kids, and I used it actually to buy an RV park, which is something going to be kind of the title of the next video. So Tom, thanks again for joining us.
Yep, absolutely.
And,
thank you, Jake.
All right, until next time, guys. Here's to your wealth.